This is not a headline market. This is a structure market. And the structure just moved. Silver didn't rally yet. That's the tell. When price doesn't react immediately, it usually means the buying wasn't price sensitive. It was availability sensitive. Something needed metal, not contracts, not exposure. Metal. Let's break this down in real time. This was not curiosity. This was not positioning. This was not a bet. What just moved through the silver market carried the unmistakable fingerprint of non-discretionary demand. Speculators hesitate. They probe. They fade rallies. They wait for confirmation, for pullbacks, for technical alignment. That did not happen here. What happened was absorption. Quiet, relentless absorption. The kind that ignores short-term price fluctuations because price was never the objective. When a buyer steps into a market and consumes supply without advertising it, without chasing momentum, without trying to optimize entry, that buyer is not trading volatility. That buyer is solving a problem. And in markets, problem-solving demand is infinitely more dangerous than speculative enthusiasm. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Share your location and local time, and I'll catch you in the next one. Watch the behavior, not the headlines. This flow did not respond to resistance levels. It did not flinch at intraday swings. It did not pause for sentiment resets. That tells you something critical. Time mattered more than cost. In financial markets, that is a rare and revealing condition. When urgency replaces optimization, it means delay carries risk. Operational risk, reputational risk, or systemic risk. The buyer wasn't asking, is this cheap? The buyer was asking, will this still be here? That single question is the dividing line between a normal market and a stressed one. Once that line is crossed, price discovery becomes secondary to supply security. Speculative money is loud. It wants attention, it wants confirmation, it wants others to follow. Structural buying does the opposite. It hides, it fragments, it minimizes footprint while maximizing capture. That's exactly what this looked like. No blow-off, no spike, no emotional chart behavior, just steady disappearance of available metal. That is how professionals move when the priority is possession, not performance. And possession-driven buying is the most destabilizing force in any commodity market because it does not reverse easily. Speculators sell when they're wrong. Structural buyers do not sell when conditions normalize because normalization was never assumed. Here's the emotional trigger most people miss. Speculative buying is optional. This was not optional. Optional demand leaves the market when conditions change. Mandatory demand stays until the requirement is satisfied, regardless of price, regardless of optics, regardless of short-term losses. That's why this matters. When mandatory demand enters a thin market like silver, it doesn't announce itself with fireworks. It tightens the screws, it drains float, it shifts the entire risk profile silently. And by the time the broader market notices, the metal is already gone. This is where fear enters. Not the loud kind, but the professional kind. The kind that sits quietly behind spreadsheets and supply schedules. The fear that asks, what happens if this can't be sourced later? That fear changes behavior instantly. It converts buyers into hoarders. It converts sellers into holders. It turns a functioning market into a defensive one. And defensive markets do not behave linearly. They snap, they gap, they reprice violently once the illusion of abundance breaks. So, understand this clearly. The absence of an immediate price surge is not reassurance. It is the warning. It tells you the buying pressure was disciplined, deliberate, and unconcerned with optics. It tells you the buyer had authority, urgency, and a finite tolerance for delay. Those are not the traits of speculation. Those are the traits of necessity. And when necessity enters a market built on leverage, rolling promises, and just-in-time delivery, the clock starts ticking. Because once necessity meets scarcity, price doesn't climb. It reorders reality. This is where the illusion lives, and where most market participants get blindsided. Silver trades as if it is abundant because paper silver is abundant. Contracts can be created, rolled, rehypothecated, and layered on top of each other without friction. This gives the appearance of endless supply, smooth liquidity, and orderly price behavior. But that surface calm is cosmetic. Beneath it sits a far smaller, far more fragile pool, deliverable metal. And the moment demand shifts from paper exposure to physical possession, the market doesn't explode. It freezes. That freeze is the warning sign professionals watch for because it signals the system is absorbing stress rather than releasing it. Paper liquidity exists to facilitate price discovery, not delivery. Most contracts are never meant to settle in metal. They are designed to net out, roll forward, and disappear. That's fine, until someone decides they don't want to claim anymore. When even a modest portion of participants demand actual silver, the leverage embedded in the system becomes visible. Dozens of paper claims suddenly point to the same limited bars. At that point, the market's job quietly shifts from price discovery to allocation. And allocation is where trust gets tested, because not everyone can be satisfied at the same time. Here's the emotional trigger. Price is not the first casualty. Availability is. You won't see panic candles. You won't see screaming charts. What you'll see is subtle dysfunction, slower fulfillment, tighter terms, fewer offers, longer timelines. These are not technical signals. They are logistical signals. They tell you the system is prioritizing who gets metal and who gets promises. And once a market starts rationing implicitly, it has already crossed from equilibrium into stress, whether the price reflects it or not. This is why silver can look calm right before it becomes unmanageable. Physical markets do not reprice smoothly because physical inventory does not move smoothly. It moves in chunks, in commitments, in contracts that cannot be unwound easily. When those chunks get spoken for, there is no marginal supply waiting to step in at a slightly higher price. There is just absence. And absence does not negotiate. It forces discontinuity. That's why the most dangerous phase of a silver move is the quiet one, when paper trades freely, but physical tightens invisibly. The structure incentivizes denial. As long as paper trades are clearing, the system appears healthy. But paper clearing only proves one thing. Confidence in future delivery has not yet collapsed. The instant that confidence wavers, participants stop accepting settlement substitutes, they stop rolling, they stop netting, they ask for bars. And that is when the mismatch between paper volume and physical reality becomes impossible to ignore. At that point, price is no longer a function of sentiment. It becomes a function of triage. This is where emotion flips from complacency to urgency. The fear is not, will price go higher? The fear is, will there be metal at any price? That fear propagates fast because it is rational. Once one participant secures physical, the next feels exposed. Once exposure is felt, behavior changes immediately. Liquidity vanishes, offers are pulled, spreads widen, and the paper market keeps trading right up until it can't credibly represent reality anymore. So, understand this clearly. Deep paper liquidity is not safety. It is leverage. And leverage works beautifully until it doesn't. Physical liquidity is the anchor of the entire system, and that anchor is far smaller than most people assume. When demand leans on that anchor, the system doesn't bend gracefully. It strains. And strained systems don't fail loudly at first. They fail quietly, through delays, denials, and disappearing supply. By the time price reflects the truth, the metal has already changed hands, and access, not charts, becomes the real battlefield. This is where markets deceive the untrained eye. People stare at candles, waiting for confirmation, waiting for excitement, waiting for a breakout that announces itself. But silver does not move that way when stress enters the system. Stress doesn't ring a bell. It backs up the pipes. Silver is not a financial abstraction. It is a physical input that moves through a narrow sequential pipeline. It must be mined, refined, allocated, fabricated, and delivered. Every step depends on the previous one functioning smoothly. When a large buyer steps into that chain upstream, the disruption doesn't appear on a chart. It appears as missing inventory downstream. And missing inventory is the most destabilizing condition a real market can face. Inventory is the shock absorber of the system. It exists to smooth demand spikes, to buffer surprises, to keep price stable while logistics catch up. When inventory is quietly removed, the system can still look healthy for a while. Fabricators keep producing, contracts keep clearing, price keeps behaving, but the buffer is gone. The moment someone reaches for replacement supply and finds delay instead of delivery, the entire psychology shifts. That's when the realization hits. This is no longer a price issue. It's a continuity issue. And markets panic not when prices rise, but when processes stop working. This is why the danger zone is invisible. Inventory depletion does not scream. It whispers. It shows up as longer lead times, partial fills, conditional offers, quiet phone calls instead of open quotes. These are operational signals, not technical ones. Professionals recognize them instantly because they've seen this movie before. When inventory thins, nobody wants to be the last buyer. Everyone wants to be early, quiet, and fully covered. That behavior doesn't spike price immediately, it locks supply. And locked supply creates a vacuum that price cannot fill quickly or smoothly. Here's the emotional trigger most people underestimate. Silver inventory cannot be scaled on demand. Mines do not respond to price signals in weeks or months. Refining capacity is finite. Fabrication schedules are rigid. When inventory is pulled forward aggressively, the system has no elasticity. There is no surge capacity waiting in the wings. That's why the market feels normal right up until it doesn't. The cliff is not visible on the chart because the chart is a lagging reflection of physical stress that has already occurred. Once inventory stress reaches a critical point, price stops behaving incrementally. There are no gentle adjustments because there is no marginal supply to price. Instead, the market jumps from available to unavailable. And unavailable does not care about fair value models, moving averages, or sentiment indicators. Unavailable forces repricing through urgency. Buyers stop negotiating, sellers stop offering. The spread between paper price and physical reality widens, and confidence in smooth settlement erodes. That erosion is irreversible in the short term because trust, once cracked, does not heal quickly. This is the structural asymmetry that makes silver dangerous. When inventory builds, price drifts. When inventory vanishes, price detonates. The move does not start on the chart. It starts in warehouses, in allocation schedules, in delivery queues. By the time price reacts, the metal is already spoken for, and the market is no longer discovering value. It is rationing scarcity. That's the moment when participants realize they weren't watching a price market at all. They were watching the shadow of a supply chain under stress. And when that shadow finally turns into price, it doesn't ask permission. It rewrites expectations in a single, brutal move. This is the moment markets quietly cross a line, the moment incentives invert. Under normal conditions, silver operates on confidence. Confidence that supply will be there later, confidence that contracts can be rolled, confidence that exposure today can be settled tomorrow without friction. That confidence creates a behavior pattern built around efficiency. Minimize inventory, maximize leverage, optimize price. But when stress enters the system, that entire framework collapses. Efficiency becomes a liability, leverage becomes a threat, and optimization gives way to a single overriding objective: certainty. Incentives flipped the instant the question changed from what's the best price to what's the worst case scenario if this isn't available. That question is not theoretical, it is operational. It forces decision makers to confront consequences that charts do not show: production delays, contractual penalties, reputational damage, systemic exposure. When those risks outweigh price considerations, behavior changes immediately. Buyers stop behaving like traders and start behaving like insurers. They are no longer seeking upside. They are seeking survival. This is where emotion enters, but not the retail kind. This is professional fear, quiet, controlled, and decisive. The kind that doesn't chase headlines, but moves capital decisively behind the scenes. When incentives flip, participants willingly overpay in order to eliminate uncertainty. That willingness is lethal to price stability because it removes the natural braking mechanism of valuation. Once certainty becomes more valuable than money, there is no ceiling, only availability. And availability in silver is brutally finite. The structure amplifies this shift. For years, the system has rewarded just-in-time behavior. Hold minimal physical. Rely on paper liquidity. Assume continuity. That works until it doesn't. When one large actor defects from that model and secures metal up front, everyone else is forced to reassess their exposure. Suddenly, not holding physical is no longer efficient, it's dangerous. The incentive is no longer to free up capital, it's to lock down supply. And once that logic spreads, it feeds on itself. Every buyer who secures metal increases the risk for the next one who hasn't. This is how markets cascade without headlines. There is no announcement that incentives have flipped. You see it in behavior. Offers disappear, negotiations shorten, flexibility vanishes, sellers become reluctant, buyers become aggressive. The market stops asking how much and starts asking how soon. Time replaces price as the critical variable. And when time becomes scarce, price loses its stabilizing role. That's when volatility stops being random and starts being structural. The most dangerous part is that this shift feels rational at every step. No one is panicking, no one is acting irrationally. Each participant is responding logically to changing incentives. But when rational actors all reach the same defensive conclusion simultaneously, the system experiences stress that no model predicts. Liquidity evaporates not because people are afraid, but because they are aligned. Aligned incentives are far more powerful than emotion-driven moves. This is why silver moves the way it does. It doesn't melt up gradually when incentives flip. It goes quiet, it compresses, it builds tension, and then, when the last marginal holder realizes that certainty has already been claimed by someone else, the release is violent. At that point, price is no longer a signal. It is a consequence of a market that no longer rewards patience, leverage, or optimization, but punishes them mercilessly. So understand the gravity of this moment. When incentives flip, the game changes permanently for that cycle. The rules that kept price contained stop working. The assumptions that allowed risk to be deferred collapse. And silver, sitting at the intersection of finance and reality, becomes the arena where that shift expresses itself most brutally. Not because people want higher prices, but because no one can afford to be wrong. Silver is not the warning light. Gold is. Gold senses stress first because it lives closest to confidence, credibility, and trust. When capital feels uneasy, it reaches for gold quietly, methodically, almost politely. That move rarely shocks. It signals. Silver, however, is not built for signaling. Silver is built for reaction. It sits downstream from gold in the stress cycle, and that delay is precisely what makes it dangerous. By the time silver responds, the environment has already shifted from concern to urgency. The reason is structural. Gold is hoarded. Silver is consumed. Gold can sit idle for decades without consequence. Silver cannot. It must move. It must flow. It must be delivered into real processes. That makes silver far less forgiving when demand tightens. When gold begins to rise, it's a whisper that something is wrong. When silver finally moves, it's because the whisper has turned into pressure. Pressure on supply chains, pressure on inventories, pressure on availability. And pressure does not resolve smoothly. It releases violently. This is where the emotional asymmetry explodes. Investors feel comfortable with gold. They understand it. They trust it. Silver makes people nervous because it doesn't behave politely. It lags just long enough to lure complacency, then accelerates with a speed that feels unfair. That's not speculation. That's physics. Silver markets are thinner, leverage is higher, and physical supply is far tighter relative to paper claims. Once momentum enters silver, there is no deep reservoir of calm liquidity to absorb it. There is only reaction. The critical trigger is when gold stops being debated and starts being accepted. Once gold's move is no longer questioned, attention shifts to silver by necessity. Participants realize silver is mispriced relative to stress, relative to scarcity, relative to urgency. That realization doesn't drip into the market. It rushes, and because silver is smaller, every incremental buyer matters more. Every removed bar matters more. Every delay matters more. That's why silver doesn't trend. It surges. By the time silver moves, it's no longer about value. It's about exposure. Those who waited for confirmation suddenly find none. Price doesn't offer pullbacks. It offers gaps. It doesn't reward patience. It punishes it. Silver's violence is not emotional. It's mechanical. A delayed reaction colliding with an inflexible supply base produces one outcome: acceleration. So when gold leads and silver stays quiet, that silence is not safety. It is stored energy. And stored energy, once released, does not ask whether you were ready. Markets don't fail because prices move too far. They fail because promises stop clearing. Price volatility is survivable. Access failure is not. And in silver, access is the real fault line. As long as participants believe metal can be sourced when needed, the system functions, even under stress. The moment that belief weakens, the market stops behaving like a market and starts behaving like a queue. And queues create panic not through noise, but through silence. Access risk is invisible to charts. You won't see it in RSI, volume, or trend lines. You see it in behavior. Hesitation to quote, reluctance to commit, conditional language replacing firm terms. That's the sound of confidence draining away. Once access becomes uncertain, price loses its role as a coordinating signal. It no longer tells participants what to do. It merely reflects who got there first. At that stage, price is not discovered. It is conceded. The emotional trigger here is fear of exclusion. Not fear of loss, fear of being left without metal while others are covered. That fear spreads faster than optimism because it is rational. No participant wants to explain why they trusted availability that no longer exists. So behavior shifts instantly. Buyers accept worse terms. Sellers raise conditions. Intermediaries protect themselves. The system tightens everywhere at once, and liquidity evaporates without warning. This is why access crises accelerate non-linearly. The first few participants secure supply quietly. The next group feels pressure. The final group feels desperation. By the time desperation appears, the market is already broken. There is no pool of willing sellers waiting for a higher bid. There is only inventory that has been spoken for and promises that are no longer interchangeable with metal. That's when paper price becomes a suggestion, not a guarantee. Silver is especially vulnerable because it lives at the intersection of finance and necessity. It is both a monetary asset and an industrial input. When access risk rises, both sides panic for different reasons, and they reinforce each other. Financial holders stop lending. Industrial users stop trusting replenishment. That feedback loop collapses confidence quickly and brutally. When access breaks, the aftermath is always the same. Price resets higher, not to reflect enthusiasm, but to ration what remains. And rationing is the market admitting that abundance was an illusion. By the time that admission is visible, the opportunity to act calmly is gone. Because in stressed markets, you don't pay to win, you pay to participate.